From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, bonds are rallying on a dovish PPI report, and it's sending two-year yields to the lowest level since May, as traders boost their bets on March rate cuts. But we begin with the big issue: more fuel for the Fed.
We're seeing inflation continue to come down.
Splashing down.
Trending lower. On a glide path lower.
The Fed really has a tough job of threading a needle.
CPI and PPI telling slightly different stories.
You're going to have these fits and starts.
Even though the Fed is suggesting that they're going to stay higher for longer, the economic data may compel them to do the opposite.
If inflation keeps falling,
It's important for the Fed to adjust their policy stance.
they will deliver those cuts, probably starting relatively soon.
The market might be a little too optimistic in terms of looking for the first rate cut in March.
The big risk, I think, for markets, and a lot of my colleagues would agree, is that inflation effectively gets stuck.
I suspect we will see inflation at the CPI level get stuck at 3%.
We are not out of the woods.
We need more data.
And the key thing will be the course of inflation.
The market is dead set on believing the Fed is going to ease. I don't think a lot's going to change that view.
It's been 5 straight days of two-year yield declines, to put it at the lowest levels in the last couple of hours, really, since May. After the producer price index data had come out, it's interesting to have seen that the yield has fallen so dramatically, even just today, a whipsawing of 17 basis points on one day alone and about 30 basis points on the week. So dramatic repricing when you look at the short end of the curve. And let me pull up the board here to talk about what the expectations are for the rest of the year, because that is just as dramatic. You have traders who are pricing in, based on Fed futures, more than 6 rate cuts through the end of the year, almost 7 before the first Fed meeting in 2025. Now, will those expectations stand as economic data comes in? We still have a lot to see before the next Fed meeting even comes around. And I want to get to our guests here, because I want to bring in Franklin Templeton, Sonal, Desai, and TCW Group's Jamie Patton. Sonal, if we think about those expectations, 6 rate cuts in 2024 alone, based on the data, does it make sense to you?
No. Short answer is no. I think the market is really running here way ahead of the Fed. We're talking about, as of today, Sonali, as you just said, it's closer to 7 than 6. The Fed said 3. And I think that's broadly okay in the second half of the year, because here's the thing. CPI does matter, and the Fed has alluded to CPI because CPI is what people effectively see, and both CPI and core CPI actually are kind of stuck. They are not coming down, and we always anticipated that this last stretch, getting back towards 2, would be a longer and harder slog than the move from around 9% to about 4%. And since then, I think things start getting a little trickier. So I do think that the market's really running here. And given the dovishness of Powell during the last press conference, to some extent, the Fed actually has itself to blame for this.
Well, Jamie, do traders then get burned? Given the rally that we've seen in the bond market more recently, do you think that perhaps people are getting ahead of themselves?
Absolutely. Our view is a bit more nuanced, where we think that the duration move, especially in two-year notes, is exactly what we expected. We talked about this the last time that you and I spoke, Sonali, where we are very bullish two-year notes. But to think that the Fed is going to do all of these cuts preemptively before they see inflation sustainably heading towards their target, we think the market is ahead of themselves from that perspective.
Sonal, if you think about the long end of the curve as well, we have seen a significant steepening. We're watching the 210 curve steepen really to the steepest levels we saw since the end of the last year, or since the end of the year before, rather. So do you think that that sustains itself, or do you think that there's even some risk in the yield curve here?
So I think there's a risk in the yield curve, in the sense that I tend to think that short-end rates have moved too much, but so have long-end rates, and long-end rates have also rallied a little bit too much. I see the long end probably selling off closer to 425, 450 as we go through the year. And I also think that the short end moves too. So yes, steepeners have a place, but I think how they have been placed probably isn't correct.
Well, how much pain does that mean? Because you're looking at a 10-year at hitting 395 right now. So if you think it'll go as far as 450 in yields, how much pain does that mean for the bond market and bond investors today?
Well, I think some, because, here's the thing. Over the last 3 months, we've gone from something like 5% all the way to where we are right now on the long end of the yield curve. So bond markets have actually had to live with substantial volatility. And I think what the Fed has done is to reinsert itself into the game in a way which I have to believe was not intentional, but it has clearly had a massive impact. It's loosened financial conditions enormously. Today's moves are going to do even more.
How do you feel, Jamie, about the long end risk, given that so many investors are pitching duration today?
I think that's where we might disagree with Sonal in that we're bullish across the curve. We have much higher conviction in bullish duration view in the front end because we do think the curve will steepen, but we remain bullish across the curve because we think that at this point in the Fed cycle, the Fed is going to keep rates too high for too long, and that will drive a larger than expected downturn. Market rates are currently priced for absolute perfection, so being long duration with forwards implying this perfect soft landing has incredibly positive risk reward. We've already gotten a lot of the move. We were max long in October. We're less long now, but we remain long. We remain long across the curve, and we think that there's a lot of value still in bonds.
How do you feel about the recession risk still? I know, Jamie, you at TCW, your CEO, Katie Koch, has been a lot more bearish than many in the market are saying about a soft landing. You even pitched a hard landing on this program before. Do you think that the rate cut cycle speeds up should economic data harden? And if it does, or soften rather, and if it does, when does that happen?
Yes, that is still absolutely our view. We think that the Fed might not do as many kind of proactive cuts come March, May, as the market might have priced in, but we think that the lags are longer, and when the economy actually does take the turn, we think that the Fed will have to cut much more than markets expect. So we are in the hard landing camp. Just never in the history of modern economic policy has the Fed been able to raise rates by over 500 basis points, kept rates there for years and years, and been able to accomplish all of that without any sort of recession. It does not seem plausible to us that would be the outcome.
Sonal, do you think that economic data starts to harden more from here? Soften more from here?
So actually here, I think Jamie's right. I would disagree somewhat with that view, in part because, that financial conditions chart that you just showed, we are effectively in a situation where where financial conditions are at the point they were when Fed funds were just 1.75%. We look at what bond markets are doing. We look at what equity markets are doing. And this has a very positive impact on the consumer, who had begun to start showing some signs of softening. And this is going to have a material impact on how the consumer feels about the outlook. That's one piece of it. The other piece of it, I think the elephant in the room really, is fiscal policy. It is incredibly loose. And again, I would add to what Jamie said regarding the Fed rate hikes that never, I would say, in modern history have we seen this level of fiscal expansion at a time when the economy has zoomed right through full employment and continues to do really rather well on the labor market side, even as monetary policy was not effectively that tight. Because here I would just note, it is tight relative to the period post-global financial crisis. It is not massively tight relative to the 50 years we had pre-global financial crisis. So I'm not saying that we won't have a slowdown, but I think a seriously hard landing is not what our base case is.
Interestingly enough, I want to quickly play this sound from that we had from Loretta Mester. This idea that inflation still isn't showing enough signs for the Fed to move. Take a listen.
I think March is probably too early in my estimation for a rate decline because I think we need to see some more evidence. I think the December CPI report just shows there's more work to do. And that work is going to take restrictive monetary policy.
We've all been talking about how we thought 6 might be too much already. But Jamie, if you think about the data that we have ahead of us, including the CPI print that had already come in above expectations, what are you looking for in the PCE that still is yet to come before the next Fed meeting?
We've really only gotten one data print since the Fed put out their updated projections in December. We've gotten December inflation. We still have 2 more months of inflation data before the March FOMC, when markets are pricing in this 80% chance of a cut. But more importantly, Mester is illustrating exactly what our view is at TCW, which is that Powell and the FOMC want to err on the side of stamping out inflation. They want to be Volcker. They don't want to be Burns. They're going to err on the side of keeping rates higher for longer. And if we get one softer print, we don't think that that changes their MO.
And really quickly here, Sonal, also, even just today, Jamie Dimon was talking about the potential for higher rates. This idea that deficit spending, as well as spending on a whole host of other things, military, supply chains, the green economy, could still lead to higher inflation and stickier rates than the markets expect. How much risk is there for reinflation at this point before the markets start to turn?
So, reinflation, I see this as potentially an externally driven shock in the sense of something coming from geopolitics, oil prices, etc. Sticky inflation, I think, is real. And a longer term underlying inflationary push rather than a deflationary or disinflationary push, I think, is also real for many of the reasons that Jamie spoke about.
We have to leave it there, but certainly a lot of data ahead before big decisions are made by the central bank. Sonal, Desai, and Jamie Patton, we thank you so very much for your time. Up next, the auction block, a record week for issuance in Europe and strong demand here in the United States. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where there's a healthy appetite for issuance. It's a record week for Europe, with sales topping 120 billion euros, more than half of that coming from public sector offerings like the UK and Spain, which saw record demand. And here in the US, demand is just as strong. Borrowers like Mercedes, Micron, and T-Mobile are seeing robust order books, more than 70 borrowers tapping the high-grade market so far this year. And over in U.S. high yield, after a slow start to the year, companies are raising around $5 billion this week. Hilton Grand Vacations giving the market some R&R with a $900 million sale. And speaking of credit, PGIM's Michael Collins lays out his current playbook.
You clip the coupon in fixed income, and I think you're still earning attractive yields. I think interest rates across all sectors of fixed income are going to be lower in a couple of years from now than they are today. So I think you clip the coupon for now. Look for opportunities. If rates back up, you buy them. If credit spreads widen, you buy them. I think that's the world we're in. You have this Fed backstop, which you haven't had in a long time.
Joining us now is Mike Best of Barings High Yields and Allspring's George Bory. Mike, let's start with the risky part of the market here, because if you expect 6 rate cuts, 7 rate cuts this year, then what starts to get attractive to you in terms of risk taking?
Yeah, well, I'll start off by saying we at Barings don't really expect 6 rate cuts and certainly don't expect them to come very quickly here. But, what we do see is, and I think it's fairly consistent with others earlier, is that we see that the path is lower for rates overall. And that should be, generally speaking, pretty good for the high yield market overall. I think additionally, investors have sort of isolated the distressed and stressed parts of the market. And, we live in a high yield market now that's predominantly double B rated, provides some discount. And we think that there's a lot of attractive yield to call opportunities out there where they're probably not pricing in the opportunities that are going to come about there.
Here's the thing, George, even if you do see rate cuts, you still have rates above 0, which is where you had a lot of issuers starting on the basis point for Fed funds next to nothing. And so if you're seeing rates generally higher than we've seen in the last decade, how does that start to impact the bottom part of the credit structure here?
Yeah, well, refining into higher rates is going to be challenging for some. We've seen that already over the course of 2023, sort of loan borrowers who've had to refi into or have seen their loan cost of funding go up dramatically are already absorbing those interest costs. As we march forward, as debt comes due, as those bonds get refied, obviously interest costs are going up. But for publicly traded companies, those are the ones with bonds typically outstanding, they're in pretty good shape. Balance sheets are by and large fairly well financed, both in investment grade and in high yield. It's really sort of deep down in the credit spectrum where you're probably going to see the biggest challenges. And those are companies that are very highly levered, and they're going to absorb significantly higher interest costs in the double-digit kind of range. Now, if they have a business plan that can absorb that, well, then that's great. But if they don't, well, then clearly they're going to have a lot of pressure. So it's sort of a double-edged sword. The absorption of higher interest costs will be problematic for some, but for most of corporate America, and by and large, the lion's share of corporate America, they're actually in very good shape. Not a lot of debt comes due immediately. It will take several years to erode through what are very high quality balance sheets. And it's that sort of gradual erosion of financing costs that companies can pivot. They can reduce debt. They can decrease their dependency on high cost borrowing. They can securitize assets. They can do things to manage their interest costs. And that's going to be the world we live in. That, on balance, could ultimately prove to be credit friendly rather than a meaningful credit headwind.
Well, then, Mike, how do you avoid the severe distress you could see? I mean, the reality is we are still seeing defaults tick higher than we've seen in prior years. How do you avoid the trouble?
Yeah, I think it really comes back to what we do at Barings, which is bottoms-up fundamental analysis on these companies. I don't think you can paint anything with too broad of a brush. So, triple C's and single B's, if they have improving credit quality, improving operations, improving revenues and EBITDA, I think to George's point earlier those are imminently refinanceable and they can sustain a lot of that. And there are still a lot of companies in the market right now that probably can't sustain their capital structures. And we're coming off of, yes, default rates are higher. Certainly, I think everybody's expecting that, but we're coming off, 1 to 0% default rates. And so, reverting back towards the mean, I think is certainly something that we expect. We think mostly, though, that's been isolated in terms of, the market and just picking on the leveraged loan market right now. There's about 10% of the leveraged loan market that sort of trades well below 80 cents on the dollar in a market in which most everything trades at par. And those names all trade at 60, 65 cents on the dollar. So they're already indicating stress. And that piece, has by and large been isolated in our opinion.
George, what do you like better? Duration risk at this point or credit risk?
I think we like duration risk. We have been moving up in quality. As you mentioned in the earlier segment of the show, we're in a fairly bond-friendly environment where policy's tight and the intention is to get inflation lower. So from that perspective, we like interest rate risk. But to go to Michael's point, at every rating level, there are quality borrowers, and it ultimately comes down to that balance sheet strength. So good security selection will drive your portfolio. And so it's not as easy as just credit or duration. We think you should have some duration and some credit. And if you do your homework, if you look at the balance sheet structure and the earnings cash flows that these companies are throwing off, we can find very attractive companies from AAA all the way down to CCC that are appropriate for different kinds of fixed income portfolios. So there's a lot to chew on in the world of fixed income. Yields are high, spreads are clearly tight, but as Michael mentioned, there will be multiple opportunities for refi opportunities as well as very attractive security selection opportunities.
Well, given that spreads are so tight, Mike, what do you think the entry point is? And do you expect spreads to widen in any event?
I think where we certainly saw spreads at the end of last year, I think that was a point that we all sort of scratched our heads and said they don't feel very appropriate right here. We've certainly seen a good bit of widening to start our year out within the high yield market overall. And I think we're getting towards, getting much closer to what's fair value on a spread basis. But again, I think it is more nuanced than just an absolute spread of the index argument. In my opinion, I think as we sort of look, again, we tend to be a little bit more global in nature. And so when we look across, around the world and we see a lot of opportunities, a lot of them are very yield centric, yield to call centric, where we don't have to necessarily decide between credit or duration. We can just, pick the yield and think they're pretty attractive. So I don't necessarily, I think there will be more opportunities that where spreads could gap out in the next 12 months. But by and large, I don't suspect they're going to be very wide gaps. I think we're going to stay fairly range bound from here on out, given just some of the positive momentum we're seeing in the U.S. economy in particular, but also in resilience globally.
George, what do you think is the most mispriced opportunity in the market today?
It's the most mispriced opportunity. Well, just to kind of go back a little bit to what Michael just said, when yields are, when high yield yields are up around 8%, your forward-looking returns for the asset class are pretty favorable. When investment grade is, let's call it at the low end of 5, but between 5 and 6, again, those forward-looking returns look pretty attractive. The one area that does tend to look fairly interesting, which is a little bit away from corporate credit, is just rate vol. Volatility in the interest rate market has been very high and remains fairly high. Playing that through, say, mortgage-backed securities or other sort of vol-driven opportunities is a great way to monetize the macro that's kind of surrounding the fixed income markets without either taking big directional bets, so having yields to have to go up or down. They're just going up and down a lot very quickly. Or you don't have to be super cyclical as it relates to credit. So, when we sort of take a nice selection of credit, add a little bit of kind of rate strategies, and then try and monetize rate vol to us is what is the most attractive kind of risk return opportunity that we see in fixed income markets today.
Mike Best, George Bory, we thank you so much for your time monetizing the macro. Everyone's a macro trader today. Still ahead, the final spread the week ahead. Earnings season still in full swing. This is Real Yield on Bloomberg. Welcome back to Bloomberg Real Yield. I want to leave you with one final thought. $90 billion. This is how much JP Morgan expects to make in net interest income this year alone. And it does assume six rate cuts this year alone. Could be more. From New York, that does it for me. Same time, same place next week. This was Real Yield on Bloomberg.